Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Today we're talking about a common tax surprise for retirees, how to handle state taxes on your Social Security benefits. Many people know they can ask the Social Security Administration to withhold federal income tax using Form W-4V, but what about state tax? This is where things get tricky and can lead to an unexpected bill if you're not prepared. Here is the single most important thing you need to know: the Social Security Administration cannot and will not withhold state income tax from your benefits. It's simply not a service they offer. They only handle federal withholding. This means if you live in a state that taxes Social Security income, you are responsible for paying that tax on your own throughout the year. Why does this matter? If you don't pay your state taxes as you go, you could face a large, unpleasant tax bill when you file your annual return. Even worse, you could be hit with underpayment penalties and interest from your state's tax agency. The very first step is to find out if your state even taxes Social Security benefits, as many do not. A quick online search for "Does your state's name tax Social Security?" will give you the answer. If you discover that your state does, you need a plan. So, how do you pay these taxes? You have two main options. The first option is to make estimated tax payments. This is the most direct method. Estimated taxes are payments you calculate and send directly to your state's Department of Revenue. Most states that require them want these payments made quarterly, typically with deadlines in April, June, September, and January. You'll need to figure out how much of your Social Security income is taxable in your state and then calculate the tax you'll owe. Your state's tax website is the best place to find the necessary forms and worksheets. Just search for your state's name plus estimated tax payments for individuals. It might seem like a bit of a hassle, but it keeps you paid up and avoids that big surprise bill. Your second option, which can be much simpler, is to increase withholding from other income. If you or a spouse receive other income like a pension, an annuity, or distributions from an IRA or 401k, you can often ask the payer of that income to withhold extra state tax to cover the amount owed on your Social Security. You would do this by filling out a new state withholding form for that specific income source, requesting that a larger amount or percentage be taken out. The same strategy works if you have a part-time job. You can just adjust the state withholding on your paycheck. To recap, the SSA will not handle your state tax withholding. You must be proactive by either making quarterly estimated tax payments or increasing withholding from another source of income. Taking one of these steps can save you a lot of stress and money when tax season arrives. Remember, this information is for educational purposes, and it's always a good idea to consult with a qualified tax professional for advice tailored to your specific situation. Thanks so much for watching. If this video helped you, please hit the like button and subscribe to our channel for more clear, simple tips on navigating your finances in retirement.